2020 is the year that changed my financial life forever. It's the year that I pulled all of my money out of a bank-managed mutual fund. It's the year that I opened a self-directed investing account. And it's the year that I learned about and bought Bitcoin. And it is all because I finally understood one single topic when it comes to finance. And it's what I believe is the most important topic for anyone to learn in today's investing climate. And that topic is money printing. The problem is, when you hear the term money printing, what most people think about the actual printing of money is flat out wrong. And so today we are going to break this down in simple terms, as we always do here at Wealth Potion. We're going to talk about what money printing is and what it actually means when you hear the term money printing. Then we'll talk about why this concept is critical to the functioning of the global economy. And last but not least, we'll discuss why it's such an important topic for you and I to understand as investors, and quite frankly, why I think the vast majority of people feel left behind by today's financial system. It's because they don't understand money printing. And so without further ado, let's dive in. What's up, everyone? This is Brandon. Welcome back to Wealth Potion, where we discuss personal finance, investing, entrepreneurship, all the great topics that we should have learned in school, but we didn't. And today we're talking about money printing. It's a topic that I've brought up in many Wealth Potion videos because it is how our financial system works. And we're gonna break down exactly what it means. Because even though you hear the term money printing, and perhaps you already fundamentally understand that it's not the actual physical printing of bills, you see these memes of Jerome Powell and the money printer, and you know that that's not how it actually works. Do you really understand what's going on behind the scenes?
Do you want to know what it is?
Today we're going to break it down, and let me start by defining money printing. Money printing is a set of financial engineering techniques that the central bank uses to manage the economy. And the end outcome is that the rich keep getting richer and the poor stay poorer. And I'm gonna break down why this happens and why, if you wanna be on the right side of history, or at least on the right side of the money printer, you need to understand how this works.
You take the red pill, you stay in Wonderland, and I show you how deep the rabbit hole goes.
To explain this, we're gonna go back in time to the year 2020. A year that many of you will remember. Maybe you were in school, maybe you were starting your career, maybe you were working during that time, but you remember that it was quite disruptive to the global economy. Perhaps you were laid off from your work or furloughed. Perhaps you had to work from home and your company had to make a lot of adaptations. And you may remember that the stock market absolutely plummeted. It was plummeting record amounts every single day for like 2 weeks straight. But you may also remember what happened right after that. The stock market miraculously recovered quite quickly while the world was still trying to understand what was going on with the pandemic, what was going on with these lockdowns. And if you're like me, perhaps you asked yourself this question: how did that just happen? How did the stock market just rally to its pre-lockdown highs and then keep going up while the economy is still in tatters? This moment is critical because the mask of the financial system shifted a little bit and many people saw what was going on behind the scenes. Again, if you're like me, this is where you started to hear about the term money printing. And that's because the short answer is that in order to save the economy, the central bank printed a lot of money. But again, they didn't print paper bills. They used a variety of financial engineering techniques that they have legal authority to use, but they don't love to explain it to you on the mainstream news.
What truth? That you are a slave, Neo.
One thing that they did is that they lowered interest rates. This is something that we've talked about in many videos. You can check out this one here. But in short, lowering interest rates makes borrowing money cheaper, and that encourages more spending in the economy. It's one of the most common tools that you see the central bank use to stimulate the economy. But they did something else during COVID. They did what's called quantitative easing, or QE. You may have heard this term before, so let's break it down. Quantitative easing is where the central bank purchases assets directly from the financial system. So you may remember in a recent video, we talked about how the central bank is kind of like the bank for your bank. So when you need to go get a loan, or if you need to deposit your money into your checking account, you go to your bank. Your bank goes to the central bank oftentimes when they need to do some financial finessing. And what happened in 2020 is that the economy slowed down. People stopped borrowing, people stopped spending. Another way of phrasing that is that liquidity dried up. Again, a topic we've talked about before, but when you are liquid, when your financial assets are liquid, that means you can move your money around very easily. You can think of water like liquid. If you own most of your wealth in your house, you're not very liquid. You're not going to sell off, the east wing of your house or a single room in order to get some cash. And so when everyone stopped spending, when the world went into lockdown, the economy froze up and it became less liquid. And so to increase liquidity in the financial system, the central bank bought assets, primarily bonds, but it's not really important what they bought. What is important is that the central bank, a private institution that is technically separate from the government, bought assets and put it onto its balance sheet. Just like any business or just like a household or an individual, the central bank has a balance sheet. And when we look at the central bank's balance sheet, that is where we can see how much quantitative easing they did in 2020. Specifically, the Central Bank of the United States bought $3 trillion of assets from the financial system. That is what is referred to as quantitative easing. Really imagine this. The central bank comes in, purchases bonds and various assets from your bank and other banks, puts it onto their balance sheet. The central bank, in return, provides cash to those banks. That is liquidity, and that is printing money. No paper bills had to be created in that moment. It was all done digitally through a set of keystrokes. But that is $3 trillion that entered the US financial system first, but then expanded out into the world. And if you look at the news headlines back then, or if you listen to the central bank themselves, you would hear that the reason that they did this was to save the economy. And in a sense, it worked. The stock market did recover, and eventually the economy opened back up. But there's a problem with this, and that is that the $3 trillion that went to the financial system did not get distributed equally. You may remember receiving $1,000 or $2,000 as a stimulus check in the mail. That stimulus check, firstly, is completely separate from this $3 trillion. But let's now investigate the $3 trillion. If you were to divide that up by the population of the United States, that's almost $10,000. And I'm willing to bet that you didn't receive $10,000 in wealth from the COVID lockdown. But you know who did is people that owned assets, because that money flows into the financial system. Banks and financial institutions then use that to buy other assets, and this is what increases the prices of these assets. This is why when you look at the stock market specifically, which is not a reflection of the underlying economy, but if you look at the stock market, things look like they recovered really quickly. This is often referred to as the K-shaped recovery, where there was this massive drop in 2020. The real economy continued to get worse because people were laid off, businesses were shut down, but the stock market, people that held assets, did really, really well in 2020 and in 2021. And then to compound that even further, what does $3 trillion entering the financial system do eventually? It creates inflation. It doesn't do this immediately, but that money flows into all these assets and it increases the money supply. Over time, these businesses increase their prices. And what does that do is it hits the middle class and the working class even harder. Capital allocators, investors, financial institutions, they are rational actors. If they receive money, they are going to invest it as best they can to increase their money in the future. It's like that old saying, don't hate the player, hate the game. But that is how the financial system works. Solutions like a wealth tax are more like a band-aid because the root issue is the central bank that printed this money through what's called quantitative easing to stimulate asset prices and save the economy. Because what they ended up doing is actually saving asset holders and actually doing more damage to regular working people. This process, by the way, where the money that the central bank prints, it flows into financial institution and then helps out the asset holders, this is often referred to as the Cantillon effect, which basically states that the closer you are to the money faucet or the closer you are to the central bank, the more money you're going to receive and the more you're going to benefit from these policies. And this is again why I don't see taxation as a viable solution. We need to address the problem at the root, which is the Keynesian economic approach to manipulate the economy through central bank action. If you're curious to learn a little bit more about the Cantillon effect, or if you want to learn about other tools in the central bank toolkit beyond quantitative easing, you can check out this week's newsletter on wealthpotion.com. You can of course subscribe on your email, or you don't even have to subscribe. You can read any of my newsletters on the website itself. My goal with the newsletter is to provide a bit more of a structured approach here, to provide all the data that I talk about in these videos in one place so that you can read along as well as watch along. Now let's talk about the key takeaway, which is, what does this mean for you and I as investors? Simply put, it means that you and I need to own assets. The people that got wiped out in the K-shaped recovery are the people that don't own assets. Assets can really mean anything. Stocks, index ETFs, gold, Bitcoin, real estate, bonds even. The idea though is that you're not saving your money in dollars. And a really simple way to think about this is that if you hold all of your wealth in dollars, and then the central bank prints a bunch more dollars and puts it into the financial system, the dollars you have are worth less. That is exactly what happens with inflation. The prices of things go up because there's more dollars going around. The denominator simply grew. So buy assets. And I know what some of you might be thinking, oh, I don't have a lot of money. I can't go buy assets. You can always start. This is again why I shared my personal story. In 2020, that's when I really started taking investing seriously. I took my cash out of my bank account. I opened up a brokerage account. I was in Canada at the time, so I used Wealthsimple. If you're in the United States, you can use something like Robinhood. And there are international ones like Interactive Brokers. It doesn't really matter what your brokerage account is. Most of them have low fees or zero fees whatsoever. The important thing is that you set up an account and you start investing. And there's been so much financial innovation in the past few years that you can now just buy fractions of a share. So this idea that you don't have enough money to get started, that is a fallacy. You can get started with as little money as you want. Now, as a bonus, you may have noticed at the beginning of this video, I mentioned that 2020 is also when I started buying Bitcoin. There's a lot of reasons that I started investing in Bitcoin, but one of them has to do with money printing. Because when the K-shaped recovery happens, when the central bank starts to really turn on the money printer, the highest risk assets are the ones that are going to benefit the most. Bitcoin is a risk asset. It's extremely volatile and it's not for everybody. But if you do have a high risk appetite like I do, if you're relatively young and you feel like you have many years ahead of you that you could afford to lose some money, but you want to have that chance at a greater price appreciation, then you may want to consider something like Bitcoin. Because when the money printer gets turned on, it's going to flow into all assets, and it's the riskier assets that are going to benefit the most. The reason I bring this up here is because, again, even though the price of Bitcoin as I record this is about $115,000, you can buy fractions of a Bitcoin. Just like a dollar has 100 cents, one Bitcoin has 100 million Satoshis. So you don't have to buy one Bitcoin. In fact, many people recommend having one Bitcoin as your long-term goal, because in the future, being a whole coiner is going to be a lot rarer than being a millionaire. You can mark my words on that. Whoa. Anyways, those are the main things I wanted to hit on in today's video. What is money printing? What it really means, which for the most part nowadays is what's called quantitative easing, and what you and I should do as investors. In short, buy assets. And if you're comfortable with risk, buy risk assets. Now, if you're curious about Bitcoin, but you're still unsure and you're not sure why Bitcoin is different from all the other cryptos, you can check out this video that I posted recently about exactly that. Why Bitcoin is unique and valuable, and why all of the other cryptos, in my opinion, are probably going to zero. Thanks for watching, and I'll see you next time.